too long ago, there was a report in the news of an elderly gentleman in Florida named Albert. And Albert had taken a routine trip to the grocery store, and on his drive home from that routine trip to the grocery store, he got a call from his wife, Mabel. Hello? Oh, Albert, I'm so glad you answered. I just heard on the radio a report of a car going the wrong way down the interstate. I was so concerned. Please be careful. Mabel, they don't know the half of it. It's not just one car, Mabel. There are hundreds of them. Albert's what I like to call an independent thinker. And we're going to be independent thinkers too over the next few minutes. I'm going to submit to you a couple of alternative definitions to two widely and academically accepted relationships in finance. And depending on which definition you adopt, there can be a profound effect on your wealth creation over time. The first conventionally accepted definition, if you don't mind, I will do this.
I hope your pen works better than the balloon.
I brought my own for that very reason. The first conventionally accepted relationship is that price equals risk. If you know one, you know the other. Price equals risk. Let's say that I'm selling my car, and so I approach you. Would you like to buy my car? I get no answer, so I assume that you must need more information than that. So I go on to tell you that there's below average mileage, it has lots of nice features, there's leather seats and a moonroof, and it even has the lights that turn when you turn the steering wheel so you can see around corners. It's blue. Would you like to buy my car? No answer. You must need more information. I forgot to tell you what my asking price is. I'm asking $12,500. Now, would you like to buy my car? You still need one distinct and critical piece of information that I have not given you so that you can make an intelligent decision, even if you happen to be interested in buying a used car, and even if the details I've given you fit what you want. What is that distinct and critical piece of information I have not given you that you need?
Quality. Has it been in any accidents?
Has it been in any accidents? Any other guesses?
Why are you selling it?
No, that's a good question. What's it worth? What is it worth? It's like when you bought your house. You drove around with your realtor, and you shopped and you saw these beautiful houses with great floor plans and excellent locations, and they fit everything you wanted, and you could clearly see the listing prices. But before you could make an offer, you needed to know what was that house worth. It's not much more than common sense. But when it comes to markets like publicly traded stock markets, this idea gets left behind. And primarily the reason for that is this academically promoted relationship that price equals risk. People who are proponents of that relationship would argue that the examples I've given you are different. Unlike a car or a private piece of real estate, the markets like public equities markets are efficient, and in such a way that price and risk, or price and, I'm sorry, this whole thing is not correct. Price equals value. Price equals value. That's important to know. They would argue that in those markets, price and value are one and the same. So if you knew the price, you knew the value, unlike, again, a car example or the purchase of a piece of real estate that's private. There are numerous reasons why that does not hold true, and it's clearly observable in the real world that price and value for extended periods of time are separate, and they should be analyzed as such. So apart from my flub, price equals value is the first academically accepted definition, and the alternative is an important concept to get, that it does not equal value, because we're going to use that to build on for the second relationship that's widespread accepted, which is that volatility equals risk. Volatility equals risk. If you can identify the volatility, you've quantified the risk. Volatility equals risk. Let me define volatility for you. Volatility is simply variance. So the more something wiggles around, in this case prices, the more volatile it is. Meaning, if something has a wider range of potential outcomes, it's more risky. In this case, again, a wider range of potential prices. Let's go on a flight of fancy together here for a minute. And let's say there's a new app that came out that you can download to your phone, and we'll call our app the Capricious Companion. You can download the Capricious Companion, and what it does is every day it will either make you a quote to pay you money, or it will ask you to pay it money every day. There's two versions of this app, version A and version B. In version A, it will make you offers and requests within a range of $5 plus or minus. In other words, the most it can ask you for in any given day is $5, and the most it can offer to pay you in any given day is $5, version A. Version B of this app is identical, except its range is plus or minus $50. One day it could offer to pay you $11, the next day it could ask you for $48. The next day it could offer to pay you $1, and the following day it could ask you to pay it $3. But the most it could ever ask to be paid by you is $50, and the most it could ever offer to pay you is $50. The terms of using the app are that you're under no compulsion whatsoever to make a decision that's not in your best interest. So you could simply choose to ignore your capricious companion. Or even better yet, you're free to choose to take advantage of those offers that are advantageous to you and say no to those that aren't. So on a day that it asks you to pay it money, you could simply say no. On a day that it's offering to pay you money, you could accept. My question to you then is, which version of this app, A, plus or minus $5, or B, plus or minus $50, is more attractive to you?
$50.
App B, version B. It would almost be silly under those conditions to accept version A. Why? Does that mean that by accepting B, Sean is a risky guy? Because version B has a lot more volatility, substantially more volatility. Is Sean risky? No. Because he's not under any compulsion to make a decision that's not in his best interest. It's the same way with publicly traded stock markets. Every day you receive a quote for what you own. Some days it's favorable, and other days it's not. Perhaps for extended periods of time it's not favorable. But if you're not a forced seller, if you're under no compulsion to make a decision that's not in your best interest, volatility is not risk. Volatility is opportunity. In most other places of thinking, if you're given additional options without attending obligations, that's a good thing. That's a benefit. Somehow in finance, we figured out a way to turn that into a liability. So I submit to you that volatility, given that you are not a forced seller, is not risk, it's opportunity. But if risk is not volatility, we need a different definition for risk, and I submit that the more appropriate definition for risk, and the one by which we invest, is the probability of the permanent loss of capital, or more specifically, the permanent loss of purchasing power, because we live in a world with inflation. Let me tie these two concepts together for you. The first alternative relationship definition that I've given you is that price does not equal value. They're distinct, they're separate. Sometimes they converge, price and value converge, but oftentimes for extended periods of time, they're separate. In the 1960s, 1970s, an investment philosophy emerged, a mentality, around what was called the Nifty 50. The Nifty 50, if you're not familiar, was a group of some of the 50 largest companies, American companies at that time, and they were thought to be the top echelon of quality and growth. So the investment mentality that emerged was buy quality, buy the Nifty 50, which in and of itself, if you stop there, that's not inherently bad. But it continued on to say, at any price. Buy quality at any price. And the philosophy that undergirded this was this, that price equals value. So if you have a Nifty 50 stock and its price got outrageously high, it was okay, because along with it came value, because price and value were one and the same. It was basically riskless. One of those companies that were part of the Nifty 50 was an excellent company then, and arguably still to this day is an excellent company, IBM. But if you had bought IBM at the height of the silliness of price equals value, and that was your definition of price and value, you would have paid a price around 1972, beginning of 1973, that was such that over the next 44 years to present, had you held that stock at that price, entry point, you would have underperformed the entire market by almost half. So what happened was you bought an excellent company that turned out to be a lousy investment. And that's only possible because price and value are different. Because those two things are distinct, you can buy a lousy company if you get a good enough price. And it turns out to be an excellent investment. So that person who adopted this relationship, over the next 44 years, the gap in the wealth that they could have created and did create was substantial. Price is what you pay. Value is what you get. They're different. The second alternative definition I've given you is that volatility does not equal risk if you are not a forced seller. Volatility equals opportunity. Risk then is something different. I submitted to you that it's the possibility of the permanent loss of your capital. Let me draw you a graph that will illustrate the second concept and how it could affect normal everyday people like us